Nancy from Nancy Chu Homes. It is the middle of July, and I just wanted to sort of do a quick touch base about where we are in our inflationary fight, our battle. So June CPI numbers came in, as well as the core CPI data. So just a reminder, if you don't know what CPI is the thing that we're using to calculate inflation and how bad things are. So the CPI basically, it measures sort of the change in prices for consumer-based goods and services based on sort of like a cross section of things that people use for, like I said, goods and services. Okay. So the Bureau of Labor Statistics, they take like a sample, a cross section every month to calculate the CPI. And what they do is they use an index of their own. They use an index, and for each product or good or service, what they do is they calculate the percentage or the share of recent consumer spending to how much that good is for that particular, percentage of the spending for that month. Okay. I know that sounds super complicated, but it's not. And essentially, that's how they have been calculating whether inflation is going up or down, right? Now, June numbers did come out, and I would say the CPI was lower than expected. In other words, it did go up, but it didn't go up as badly as we were afraid it would. So, yay! Uh, so the response was mortgage rates dropped a little bit. So we saw mortgage rates go from, I don't know, like 7.25 to like 6.8, which, by the way, was a super sexy drop. I just want to point out that looked significant after you get sort of accustomed to seeing something with a 7 in front of it. Seeing something with a 6 in front of it suddenly looked very exciting. FYI, PPI number, so that's basically the wholesale inflation number. That is also not as bad as we had hoped. So this is good news, right? We're thinking, this is great. We can put a stop to these rate hikes. Well, okay, it's the Fed, and the Fed does not seem to be interested in logic. And instead, they were like, 2 more rate hikes. We definitely want to see 2 more rate hikes. July, over the next 4 times that they meet, they're anticipating 2 more rate hikes. On the positive side, the mortgage industry seems to have calculated those rate hikes in, so we shouldn't see any significant mortgage increases. Okay, hopefully not significant. Listen, the rest of the world is like, stop, Fed, stop. And the Fed is like, no. There's a particular portion of how CPI is calculated that I want to talk about today because I think it's part of what's causing our problems. And that problem is the thing called owner's equivalent rent. Okay, that's what we're going to talk about. So CPI is literally like 1/3 shelter, right? Like shelter is a big, big number. Shelter's been our problem and really the main root of our inflationary issues for a little bit now. Okay. Now, I will tell you that shelter is probably responsible for 70% of the CPI increases that we're seeing. It's a lot, all right? But it's this weirdly measured thing that I want to talk about, which is a full 25% of that shelter number, okay, which is like 1/3 of the overall number, a full quarter of that is in what is called owner's equivalent rent. Now, we're going to talk about that. What is owner's equivalent rent? It's this survey, as in like pick up the phone and call people or get them to fill out a form. We all know how users use surveys. They use them poorly, inevitably, right? But what it does is it uses a survey that has since the 80s, and it basically asks people who own homes, hey, how much money would you have to pay in rent that would be the equivalent to the cost of the ownership? So in other words, you own this house, you live in this house, but how much would it cost for you to rent this house? It's basically something that they use to put a value on real estate markets. And the thing that drives me crazy is that there's no stopgap on this, which means 25% of the shelter number is literally gotten by a survey where you call people and say, how much do you think your house would be worth renting right now? Well, what do we know about owners? They have no idea how much their houses should be rented for. And most of the time, many of them just go, well, I don't know, my neighbor got this, and so therefore I think mine should be this. It doesn't matter that your neighbor's was renovated last year and yours hasn't been touched since 1967. So we're relying on a significant number of people having an accurate understanding of what their owner's equivalent rent actually should be. This is some pretty scary stuff, in my opinion. So what happens if we were to take just that 25% of the owner's equivalent rent out of the conversation? Let's just pull that out. You know what? If we pulled that number out, which by the way, I don't think those numbers are accurate at all at this point. If we pulled that out and didn't consider it part of the conversation, we are very close to the Fed's 2% target rate. Very close. We're not that far off. Okay? We're that close to the Fed's 2% target rate. That's some pretty scary stuff, right? That we're letting essentially people who own their homes to sort of make up some information, and we're calculating our entire economy based off of this. This is pretty scary. Listen, if the Fed continues to utilize this information and they overcorrect, we know what's going to happen. They're going to end up having to reduce the interest rates later. And then we all know what happens when you reduce the interest rates. More buyers suddenly hit the market like hail, like a pent-up hailstorm. They will hit that market and they will spike competition, which therefore spikes prices. We all know this already, right? There is no real sign coming down the pike of any sort of significant inventory increase. I'm sorry, there just hasn't been. And so I don't know what happens if interest rates drop below 6%, between 5.5 and 6%. It's going to unlock inventory, and it's going to then result in an increase in buyers coming to the market. I know it sounds exciting, the idea of unlocking inventory, but the truth is most people who are selling their homes are first and foremost buyers, okay? The Logan Motoshami says this over and over again. He says, people do not sell their house to be homeless. They sell their house because they want to do something else. They want to purchase something else, whether or not it's, I want to purchase a bigger house for my family, or a smaller house because I want to downsize, or because I got a job in Oklahoma and I want to purchase a house in Oklahoma. They do not sell unless they want to purchase something first. Okay, most of them, like 90% of people who sell their homes are equity buyer sellers. Okay, so if you unlock inventory, you're actually unlocking buyers as well. So once again, we're going to see prices continue to rise. All right, and right now with inventory low, you know what's fantastic? I've seen great situations where I'm like, guess what? Hey, we're going after this house. It's only 2 or 3 offers. We can fight, we can win with 2 or 3 offers. It's very different when that inventory unlocks and those equity buyer seller buyers come out and they have a ton of equity to work with, and they suddenly produce 10, they increase the competition. So you go into 10, 30, 40, 50 offers is not out of the question in some markets, especially in the Northeast, you know, especially in California. There are places where that kind of market interplay happens when you introduce more inventory and subsequently more buyers. All right, you get more intense multiple offers. So what does this mean? It means that if the interest rates actually go down and we unlock inventory, it means you, Mr. First-time home buyer, will likely become priced out of the market again. So what is it that you're looking to do? If you want a home, don't dilly-dally. Don't dilly-dally. It's a good time to buy if you want your competition to be reasonable and manageable, versus if that changes and you're suddenly going up against significant multiple offers with an interest rate decrease. All right, guys. That was my rant for the day. Please do not forget to comment, like, and subscribe. If you at all pay attention to our YouTube page, it would be super helpful because I would love an opportunity to talk to more people and get them to understand what we think is happening in the market right now. All right, guys, I'll talk to you next week.